Is a 3-fund portfolio still the king? Does it accomplish everything that it's supposed to? Or has it become such a loser way to invest that everyone should just abandon it? Let's find out. A 3-fund portfolio is made up of, you guessed it, 3 funds. A US stock fund, either in the form of a total US stock fund or an S&P 500 fund, a total international fund, and a bond fund. You can build this portfolio with index funds offered by Vanguard, Fidelity, and Charles Schwab, or you can build it using the ETF version of these index funds, like the ones offered by Vanguard. On the surface, it looks like the 3-fund portfolio isn't special at all. It's just 3 funds. That is not very sophisticated. However, underneath the hood, there's a lot going on that isn't so obvious unless you know what to look for. Now, some people will knock on each individual fund to determine whether or not the 3-fund portfolio is still a good investment. But before we cover those concerns in more detail, let's look at some of the supposed benefits of a 3-fund portfolio to see if they still hold up. Because the 3-fund portfolio is extremely easy to build and manage on your own, it's safe to say that there's still no need to open yourself up to the cost and potential risk of working with a financial advisor sooner than you have to. To be clear, not all financial advisors are scumbags, but some of them are. And in my opinion, the ones who charge a percentage-based fee on the amount of money that you have invested are insanely expensive and very rarely worth it. A 1% advisor fee will actually cost you 26% over 30 years and 33% over 40. Sure, you would be a millionaire if you didn't pay so much darn money to your financial advisor over the years. If you really feel the need to work with an advisor, then stick with a flat fee fiduciary advisor or planner. Yes, you'll have to pay some cash out of pocket up front, which might feel a little bit uncomfortable, but this decision could save you hundreds of thousands of dollars in fees. Advisor risk isn't the only thing the 3-fund portfolio protects you from. It also protects you from fund manager risk as well. Since each of the 3 funds are based on an underlying index, the manager of these funds are just buying what's held within the index. He or she doesn't need to be some stock market superstar to get the job done. With all other non-index based funds, you have a manager who is actively choosing stocks based on a strategy that they think is going to be successful. Sometimes they're pretty good at it, like Peter Lynch was for 13 years before he retired. And sometimes they're really bad at it, like Cathie Wood. And sometimes they're so good that they are named the best manager of the decade, only to ultimately underperform. Successful investing is extremely difficult in general, and even more so over the long run. Yes, even for professionals who do this for a living. There continues to be no individual stock risk with a 3-fund portfolio. Since the 2 stock-based funds invest in roughly 12,000 of them combined, the risk is spread out among a ton of companies. Successfully picking individual stocks and consistently coming out ahead over the long term is extremely difficult. Don't get me wrong, it's possible to do over the short term, but the probability of continuing to do it decreases as time goes on. There also continues to be zero overlap with a 3-fund portfolio. Fund overlap happens when you invest in more than one fund that holds the same stocks, which ultimately reduces diversification and increases risk. An obvious example would be investing in an S&P 500 ETF and something like a dividend ETF. In this example, 54% of the stocks held within the dividend ETF are already in the S&P 500 fund, so by investing in both at the same time, you're less diversified. Because a 3-fund portfolio allows the market to determine where money gets invested, there's no sector risk. Trying to predict which sectors are going to be the biggest winners at certain points in the future is a fool's game. It's obvious to see and understand looking back, but successful investing is about looking to the future and not the past. The 3-fund portfolio is set up to capitalize on all future sector trends. There's no style drift with a 3-fund portfolio. This happens when an investor tilts their portfolio too far towards one style, causing them to be less diversified. These are some different styles and asset classes investors will tilt towards with their portfolio to attempt to gain an edge. The problem is that no one knows which direction the market is going to go and when. Some years they work, and some years they don't. Here's a dirty little secret investors don't like to talk about. When they tilt their portfolio in one direction and it doesn't work out, they will not tell you about it. When it does, they will tell everyone. Survivorship bias is really good at sweeping the truth under the rug, which is easy to do nowadays because Chinese spyware, aka TikTok, has destroyed everyone's attention spans. Since a 3-fund portfolio invests in the entire market, it's built to be able to capitalize on every single style and asset class. With a 3-fund portfolio, you get above average returns compared to professionals and average investors. Over the past 20 years, 93% of US funds underperformed, 92% of international funds underperformed, and 81% of bond funds underperformed. Imagine if 93% of planes didn't make it to their destination. Probably wouldn't be a great idea to hop on that plane. Every few years, JP Morgan releases long-term returns for the average investor, and it never looks good. Once again, it's definitely possible to outperform something like a basket of total market funds, but the probabilities of success are lower than my self-esteem. A 3-fund portfolio is optimized for contributing, managing, and withdrawing. This reduces your chances of accidentally messing something up and makes all decisions so much easier. When you're ready to invest, you only have to worry about buying 3 different funds. Managing the portfolio during the accumulation phase of investing is also insanely easy. You only have to worry about 3 things: staying invested no matter what, making sure to stay close to your desired asset allocation when you invest new money, and rebalancing once per year. Other than that, the 3-fund portfolio manages itself. And when you're ready to withdraw in retirement, you only have to worry about selling off a combination of 3 different funds. I've seen the Frankenstein-looking portfolios some of you have out there. It's all fun and games until you realize the amount of time you're wasting trying to figure out how much money to put into each fund and how big of a headache it's going to be trying to pick which combination of those 15 funds you want to sell when you need the money in retirement. The fees you pay to invest in a fund can also make or break your chances of becoming wealthy in the stock market. Luckily, a 3-fund portfolio still has some of the lowest out there. Take, for example, the average expense for a 3-fund portfolio, which is about 0.03%, versus an expensive actively managed fund like ARK where they charge 0.75%. Investing $1,000 per month for 40 years into a 3-fund portfolio would cost you about $20,000 in fees, and $461,000 in fees with an actively managed fund that charges 0.75%. On top of that, don't forget about how 93% of funds underperform. So not only are you paying $461,000 in fees, but you're also most likely losing money based on what the fund is investing in. Sorry kids, daddy can't buy you braces this year because I enjoy paying a lot of money in fees and underperforming a 3-fund portfolio. Fees always have and always will matter. Anyone who tries to tell you differently either doesn't understand math or they're trying to sell you something that you probably don't need. Since these 3 funds hold literally every stock and bond available, it's as diversified as you can get, which gives you one of the best risk-adjusted returns. Trust me, I know what Warren Buffett has said about diversification and understand that he doesn't worry about it with his personal investments. But we're not Warren Buffett. And as I touched on a few minutes ago, even the professionals who know what they're doing and spend 40+ hours per week on it still underperform. There's this beauty and benefit to simplicity that's easy to miss when we're talking about something like a 3-fund portfolio. Jack Bogle said, "How do you associate yourself with winning businesses? Simply by buying a portfolio that owns shares of every business, then holding it forever." Keeping things simple with investing almost seems too good to be true, like even an idiot could do it. Well, Jack also said, please don't equate simplicity with stupidity. Just because it takes effort to build a complicated portfolio doesn't mean that you should or that it's going to be successful. This is counterintuitive to other areas in life where effort does lead to success, so it can be tough to wrap your head around it. Effort with investing doesn't automatically equal valuable. Sometimes the minimum effective dose is all that you need. Any more than that has diminishing returns and increased consequences. So let's address the 2 biggest criticisms of a 3-fund portfolio: the bonds and the international stocks. First, bonds are not stocks, so we shouldn't expect them to move the exact same way. And as we saw recently, there are times when bonds get crushed alongside stocks. But just like how we don't say that stocks don't work because they're down, it also doesn't make sense to say the same thing about bonds when they're down in the short term either. Vanguard reminds us of the point of holding a bond fund. They give you a stream of income and they offset some of the volatility you might see from owning stocks. So while bonds have not looked great on their own recently, they've generally still offered a little bit of cushion within a 3-fund portfolio when stocks are down in the short term. And oh my gosh, people, please stop saying that a dividend ETF is a good replacement for a bond ETF within a 3-fund portfolio. I've received questions about this in the comment section of my videos recently, so I'm sure there's some YouTube channels out there saying this. I understand you want to get fancy by calling something the new 3-fund portfolio, but at the end of the day, dividend stocks are still stocks. They're not bonds. It's not an optimal trade-off based on the fundamental truth of what they are. The whole international side of things is where there's a huge divide between the people who say to invest in them and the people who say to avoid them. I mean, look at this freaking chart of international versus US outperformance. Everyone who is said to invest in international has looked like a complete fool over the past 13 years. Can't say I blame anyone for not wanting to touch it with a 10-foot pole. If my girlfriend cheated on her last 13 boyfriends, then it'd be tough for me to make a case for why she's not going to do it to me going forward. But that sweetheart of a gal might turn a new leaf, and those international stocks just might start performing better than US as they once did. The past is great for showing us how things have played out, but it's not helpful in determining where we're going. So does the 3-fund portfolio still work? Yes. Does it accomplish everything that it's supposed to? Yes. Is it still the king since it's the perfect portfolio to buy, hold forever, and minimize a ton of other decisions? Yes, it is. Look, the 3-fund portfolio is constructed the way it is for a reason: to simplify, diversify, and improve your risk-adjusted returns based on an unknown future that's impossible to predict. Trying to look at recent past performance of the individual funds to determine whether they're going to be good to hold going forward doesn't really make sense for a portfolio like this. The point of this portfolio is to say, hey, I admit, I have no idea what's going to happen in the future. Because of that, I'm going to make sure that I'm as prepared as I can be no matter what happens. When you start replacing any of the 3 funds with any other funds, you start reducing your overall diversification and lowering your risk-adjusted returns. Yes, on an absolute return basis, you could outperform a 3-fund portfolio, but you're not being compensated for the additional risk that you're taking on to get those higher potential absolute returns. At the end of the day, if you don't want to use a 3-fund portfolio or you want to alter it, then have fun. I don't care. As long as you understand what you're giving up and you can handle whatever outcome you get. It's your money and I'm not your daddy, so do what you want. All I honestly care about is you feeling comfortable enough with your portfolio that you stay invested even when things aren't looking great in the short term. Oh, and do me one more favor. Try to stay open-minded about a 3-fund portfolio, even though you might not invest that way right now. Because as you get closer to retirement, a lot of things change, and it might just make sense for your particular situation. Helpful investing resources are down in the description below. Hit that thumbs up button, please. Done.